Okay.
Good afternoon. My name is Marcia VanderWoude. I am Senior Adjunct Professor of Personal Finance at Grand Valley State University. And this is Shelley Irwin. Tell us about yourself, Shelley.
Hi, I'm Shelley Irwin. Good to be with you. She's awesome. I work for Grand Valley with WGVU Radio and Television, host a 2-hour morning show, a variety of television issues as well. I started my career out as a physical therapist and then chased the broadcasting dream a bit later. So I love what I do and love to get the word out. But I, this is kind of an area where I look to learn more here, the stocks and bonds and all that good stuff.
Great. Well, Shelley, you told me that you own some individual stocks at this point. So what I want to do today is teach you how to sell naked puts. It's sort of a strange statement, isn't it?
Is that allowed?
So anyway, let me explain options a little bit in the first place. There are call and put options. Now, the person who's buying these options that trade all day long on the Chicago Board Options Exchange, the person that's buying these is a gambler.
Legally.
Yes,
Yeah.
legal gambler.
Yeah.
But people that sell these options and receive money for that are called hedgers. So it's a great way. I just did a video on covered calls. Covered calls means you own the underlying stock and you're willing to sell a call option at a higher price to get called, in other words, sell your stock at a higher price at a later date. And those prices are called the strike prices. But when you sell puts, you are willing to get put. In other words, buy some stock. And you don't have to already own that particular company. But it's a good way to make extra money on your portfolio. You have to have a margin account. Do you have a margin account, or don't you know that?
I don't know that.
Okay. So the first thing you need to do is find out if you have a margin account. Where do you keep your securities?
In the bank?
In the bank trust department, or?
They're divided up in certificates. I don't have like a Charles Schwab one-person account.
Oh, okay.
Yes, I have just funds that run their own ship, I guess.
Okay, but you own individual stocks
Yes.
in there, held at the bank?
Well, I guess held with wherever they are. I bought them directly from the organization.
From the bank?
Not from the bank, from the organization, from the stock.
Oh, I see.
Yeah.
Okay.
Hope I didn't
Well,
do that right. I might not have done that right.
No, that's fine. But what you're going to have to do in order to write naked puts is
Yes.
you're going to have to set up an account like at Schwab or Ameritrade.
Yeah.
Now, I have mine at Ameritrade. So you set up your account at Ameritrade, and you can deliver your stocks into there if you want to use them for your margin. Stocks release 50% margin. However, if you want to release more margin, you can buy some treasury notes
Oh, yes.
because they release 90% margin. Okay.
Higher the
So-
better?
Yeah, so in other words, you might want to buy some 2, 3, 5-year treasury notes to keep in there. And then we can start selling some naked put options in order to both generate money and maybe also get put the stock, so you would own some.
Yes.
Okay, so that's what we'd have to do first. So you open your account at Ameritrade,
Okay.
and then you make sure that you have option papers. You have to fill out option papers to get approved to do this.
Can I do this all online?
I think so, but I have a person at Ameritrade in Granville that I
Oh,
can
nice.
refer you to if you'd like. So you have to fill out option papers, and then you have to get it structured so that you have margin capability.
Okay.
Cash doesn't count.
Gotcha.
All right. So, okay, in other words, what you're going to do is you're going to say, I want to buy some Apple stock.
Okay. Yes.
Okay. I'm willing to get put Apple stock. Okay?
Okay.
You don't own it at the current time, right?
Right.
Okay. So let's take a look at Apple. If you will put AAPL right there and look in the quote box.
AAPL.
Right.
Searching. Here we are.
Okay, there we go. Okay. So its current price,
171.
let's skip the pennies. 171. and give me the 52-week range, the summary there. Well, and if you scroll down, you'll see the summary for the 52-week range. So it has traded between 150
150 or
and 150. This
I
is
see.
the day range. This is the 52-week range. So 150 to 233.
Okay.
So that would be a nice price at which the market's fallen a lot lately.
Yes.
So let's say we're going to then see, once we look at the current price and the range, then we say, okay, then we can select some strike prices. So now you would go back to that bar that was at the top. You might want to scroll
back
up there.
Mhm.
All right, see that bar called options?
Yes.
All right.
Got it.
So you're going to see call options and put options. So
Oh,
today
yeah.
we're going to talk about put options.
Huh.
So now we don't want them expiring on this date,
Which is
so
Friday.
We hit that little down bar.
Okay.
Oh my, there's lots of expirations. Let's look at April.
Okay. 418.
Right.
Okay.
They all expire the third Friday of the month.
Goodness.
Wow, there's a lot of strike prices. Okay, so you keep going down until we get to something like perhaps.
Oops. Keep going down on this.
Yeah, you got to keep going down on the strike prices so that
Okay.
you get
keep
to
going
something
higher.
that, if it's one, all right, maybe we could
There's
start looking
140.
here.
There's one
Yeah,
following your guidance.
okay, so let's maybe do 3 different strike prices and see
Okay.
how much you're going to make.
Okay. Wow.
All right, would you be interested in buying 100 shares at 135?
Yes.
All right, that's the strike price. Say we'll sell 1 put, and the strike price is 135, so you'd be willing to get put 100
Okay.
shares
Okay.
at 135 by the third Friday of April. So this is $2.38 per share that you're going to get.
Huh.
That's called the
Okay.
premium.
Huh.
So you're going to get $238 for that one. Okay?
Okay.
All right, now let's
Yes.
say you'd be willing to get put 100 shares at 140.
Okay. Right there we are.
Right.
305 is your.
Right, you're getting it. 1 put at 140 strike price. And we're going to get $305 for that
Oh,
one.
that's how that works. Okay.
Okay.
Huh.
And then 150. Let's say you're
Okay.
willing to buy. So you got to have a lot of money or a lot of margin that you can
Yes.
buy all this if you get put.
Right. Okay.
Chances are it's not going to go that low.
Okay. Just the way.
So, right. So
in
1
6
put
months.
at, these are all April. 150, and you're going to get
480.
406,
150 is 480.
480. You're going to get $480. Okay. So just the speculation that you're going to.
You're going to add all those up?
Yes, and then that money, today is a Wednesday. So let's say you did it today. You're going to get in your account tomorrow $1,020. Okay?
Okay.
Now,
Huh.
what happens now between now and April?
Let's say the market goes way up.
Right? Okay. And Apple goes way back up to 200 or something like that. Okay. That's okay.
Is it okay?
Yes, because you're not going to get put, but you're going to have this extra $1,000.
Okay.
Because all these will expire.
All right.
Okay, now what if you said, okay, it's at 171 right now, so let's go to the 170 put. So let's say you're willing to get
11.
put 1 put at 170 because that's close to where it is, and you think the stock's going to just keep going up anyway, so you
1196.
yeah, so you're going to get $1,196. So 11 to $2,200 you could make today if you were willing to take those risks. So what are the risks?
Yes. What are the risks?
If it gets below 170, it's on
The
the
price of
third
the stock.
Friday of April. Yes,
Okay.
correct. You will get put 100 shares,
Okay.
170. So that's $17,000.
That's good.
Maybe.
Maybe.
Yes, if you believe in the stock,
Okay. Wow.
yeah. So you can make some very decent money. And you read about my client
Yes.
who she
They-
made
Their
$120,000
business. Yeah.
just by
Mhm.
writing naked
Mhm.
puts on an $800,000
Wow.
portfolio. So that's
Yes.
a really good rate of return.
But there's the other side.
There's the risk. What if it goes to zero? You're going to get put all of this. So,
So I have to write a check.
well, it'll be, yes,
Or-
you'll have to take some cash if you don't have cash in there too, to buy it. Because you don't want
to buy
be on margin. You don't want to
Okay.
owe interest besides. So,
Right.
so you'd have to put in lots of cash
Okay.
for that. Presumably you have
Mhm.
enough capital
Mhm.
that you could do that.
Mhm.
All right, now, what about any of the stocks that you said you wanted to take a look at? Nike, so
Yeah,
let's see
take
how
a look at
Nike looks.
Should I go back?
Yep, you go back and you go back to the quote search and you put in, I think it's NKE.
I don't want to go too back. Okay, now I go back to markets.
Right down here,
Okay.
quote search.
So N, what'd you say?
NKE, I think, is Nike.
Yep.
Nike, okay. So let's go to the summary. Current price is 74. High and low is,
Keep going down, right?
yep, keep going down. 52-week range was 60
Huh.
to 86. Well, this is a good one to look at as well. So then you go back up and find that option bar.
Oh.
Oh. Oh, that's
Oh.
December, that's why we have
Oh, that's
to go.
right. We want to go
We have
back to April again?
We can go to April. Let's try June. June. And you go to the put options.
Yes.
Go to the put options. But you can also, I can teach you how to do calls on your stocks too.
Huh, okay.
But this lesson happens to be about
Yes,
put.
yes.
Okay, so let's go out farther to near 60.
All right, there we are, near
There we are,
60's
so-
141.
All right, June sell 1,
June.
1, June 60 put. And how much money are you going to make?
$141.
$141. Okay. Now, so then you will be willing to get put at 55. You'd be willing to get put
Okay.
100 shares. 55.
And
What-
that's
how much are you gonna make?
$82.
$82. All right, and you'd be willing to get put 100 shares at 62.50.
That's $230
230.
for 62.50.
Right. And would you be willing to get put 100 shares at 65?
$241.
$241, okay. So,
Okay.
and see, that's pretty conservative, although if Nike goes to zero, you get put all this stuff.
Yes.
So the way probably
That's
to
the
start
risk.
out is just to do one contract
Okay.
and see how that goes,
Mhm.
and then get braver as you
Yeah,
do
yeah,
this.
as you do this, right?
Yep, so let's say you did all the Apple and all the Nike today.
Okay.
That's $694. And
That's,
we already looked at how much you're gonna make, $22.16.
it's going to be a good day.
It's gonna be a real good day for you. You can go out to Cygnus for
I can
dinner.
go out, right, and just blow it on the appetizer, I guess.
$2,910. So,
Hmm.
you have a
Very
basic
interesting.
idea about
Yes.
this strategy.
Yeah.
And it's more risky than selling covered calls. That's why you have to have margin account. You
Okay.
can't do this in an IRA. Whereas
All right.
with an IRA, you can do covered calls.
Okay.
So I'd have to
Huh.
see where you keep your stocks.
Yes.
And then I can teach you the strategy
How that
also
works.
of the covered calls.
Okay.
Okay?
Wow.
How does this sound?
It sounds
something
good.
You might want to
Yeah.
give a try to?
Sounds like it's a win-win situation.
Okay, well, that's our lesson on writing naked puts, and we will do another video on bonds.
Thank you, Marcia.